Hello, 12 Points clients. This is Dave Clayman, CEO, checking in regarding the recent market volatility since the all-important CPI or Consumer Price Index number came out last Friday. The number was far more inflationary than people had expected. That is, people outside of 12 points. We've been talking about inflation, as you may have heard, since last June at least. That surprise in inflation has caused markets to suddenly realize that the Federal Reserve is behind the curve, meaning they have not raised interest rates fast enough to accommodate for the inflationary environment we're in. Now, obviously, none of us like interest rates to go up, except if it's for savers. And rising interest rates affect a lot of things in our economy. Obviously, mortgages. Mortgage rates have jumped to a 6.28% rate as of today. Those things are putting pressure on both the bond markets as inflation goes up and the Fed raises rates, prices of bonds go down, and stocks, particularly those large growth stocks that we've been talking about for the last year that were priced based on extremely low interest rates. They had high valuations because of those low rates, and now the market is coming to that realization. Our portfolios have held up relatively well, meaning they're beating their respective benchmarks by between 6 and 8% for the year. Now, we still know that's disappointing for markets to be down at all, but we've had a really good run of 3+ years, and the market needed some of the froth to come off. We've managed these ups and downs reasonably well, based on the fact that we had selected stocks which largely represented lower valuations, small cap stocks, mid cap stocks, tilting away from that large cap growth we had talked about. On a go forward basis, the stocks that we own in the portfolio are generally priced anywhere from 5 to 12 times earnings, most of them in the single digits, whereas the market average is about 16 to 17 times earnings. This bodes well for the opportunity to make money from these levels in the future. Now, we have a very important meeting tomorrow for the Federal Reserve, where they're going to make a decision on raising interest rates. That interest rate rise will likely be between 0.5 and 0.75%. It might actually be healthier for the Fed to raise rates by 0.75%, because it would give them back the credibility that they have the situation under control, which is what the market fears right now, is that they've lost control of the situation. We remain confident that we are well positioned for exactly the environment that is unfolding, that we have kept our bond duration or length of time short as opposed to the regular markets. The shorter the bond duration, the less sensitive they are to interest rate rises, and that we have bought undervalued or cheaply valued securities, stocks, in the portfolios. We also have had our ballast of alternatives, whether it be real estate, gold, real assets. Those things have provided some of the outperformance that we've had this year. We will be watching with great intent what happens with the Fed tomorrow, and we will be back with another update shortly. But we believe that we have positioned ourselves and your portfolios as well as we possibly could in this environment, and we've positioned ourselves to prosper in the market that is to come. If you have any questions, you can always reach out to your advisor, our Chief Investment Officer, Steve Bruno, or myself directly. Thanks very much, and we look forward to working through this challenging time with you.